As President Trump imposes a 25% tax on all cars and light trucks not made in the U.S., it's set to go into effect on April 3rd, by the way. Shares of the big three U.S. automakers are sliding on the back of the tariff announcement. These new duties, as I said, start to take effect, April 2nd, and add to existing tariffs. And here to comb through the extent of bleed through for the auto industry, we've got Bernstein senior analyst Daniel Roeska, who is joining us. Daniel, we've been trying to piece through all of this and the effect it is going to have. But I assume the automakers are very concerned at this point about the effect it's going to have on their bottom line. So give us your big picture impact, first of all.
Yeah, they should be. If this goes unmitigated, so if we just calculate what is the cost of the tariffs if we would have continued 25 as planned, the cost is $110 billion or $6,700 per car. So very clearly, this cannot go unmitigated. And so the next step then is to figure out who will raise prices and who will actually pull back volumes in the US market.
As costs go up, Dan, I was just asking Julie about this. What does this CEO do? Is he in a position to eat the costs? He passes that along to Josh and Dan, or would you think there's some type of mix there?
It's going to be mixed. We estimate that it's going to be a 7% price rise. Pretty much half of it the consumer will need to take, half of it the companies will need to eat. Because if you think about it, the total gross profit of the US automotive industry is only $140 billion. So the tariffs would eat up almost the entire gross profit of the US sector.
And something I've been trying to think, to piece through here and try to understand is, you have a 25% tariff on autos and light trucks. You have a 25% tariff from Canada and Mexico, imports into the US, although there are some exceptions for USMCA. Could we see a scenario where some of the vehicles being imported into the US get a 50% tariff?
No, I think that's too high, because what they announced is basically a tariff on all non-USMCA cars. Okay. And then there's a second tariff where you actually within the USMCA can offset any value that you create in the US.
Gotcha.
Dan, who in your coverage universe, what are the names that are sort of most at risk of this?
Look, Ford and GM. Yeah. That's the one. If we kind of parse this through, even with raising prices, lower volumes, the EBIT effect could be almost 30% negative to what they guided to this year. And that's clearly not what we're seeing in the market yet, and so there's still some downside risk to these stocks.
Why aren't we seeing it in the market? Are investors assuming that this is not going to go into effect or not going to last very long, and is it a mistake to assume that?
I think the market's slowly shifting. So 2 weeks ago, everybody would have told you this is 4 to 6 weeks, it's not going to be longer. There was a very high confidence in the market this would not extend. This has really shifted since the press event we had yesterday. And now it's more, well, maybe the administration will find some way within the USMCA to actually carve out a little bit more freedom for the US automakers, which then puts them at a still bad position, but relatively better than Toyota or Mercedes or some of the foreign makers.
How hard is it, Dan, right now? I mean, you have to, you're thinking, okay, buy, sell, hold on these names. But now it's not just about, okay, I like the CEO, I like their strategy, I like their product portfolio, I like the financials. You have this enormous policy risk. I mean, how do you try to work through that, both as an analyst and for investors who are listening?
So as an analyst, we've advised clients since the beginning of the year to stay out of this. As an auto sector analyst, that's not the best advice for my business, but it was just too uncertain. I think right now, of course, there's still some hope. Will we see a rollback? Will this change? I would argue that within a week, I think we'll have a pretty good feeling whether this sticks around, what the framework is. And then actually analysts like me and on the buy side can get to work and kind of parse the numbers, work with the companies to figure out what can they mitigate, what's their strategy. And I think that's going to be really interesting as we kind of head into Q2, because then we'll really have some investment opportunities here.
Something else I'm really curious about. So if the end game with these particular tariffs, and we know different tariffs for different things have different aims. If the aim here is to reshore American manufacturing and have autos made in the US, let's say, as a thought exercise, all of the cars made outside the US that are sold in the US, that they're reshored. That these automakers spend the money to build the plants, hire the people here. How much would that make US cars? How much would they cost? Would they be 25% more? Would they be more than that more?
I don't have a good answer, but the answer is between 0 and 25. So it's pretty clear. No CEO will reallocate anything to the US if the cost is higher than 25%. But at the same time, if I'm making something in Mexico and I'm now making it in the US, I'll have to have fresh invested capital. I'll probably have a little bit more stringent regulations. I'll have higher wages for the UAW labor agreements. And so the cost is going up. If I had to take a ballpark guess, somewhere between 10 and 15% if I'm doing a really good job. But that means whatever happens, auto prices are going up.
And that means what ultimately for demand, Dan?
Demand's going down. So originally we went to the year, said, look, it may be 16.5 million cars this year sold in the US. Over the initial weeks of the year, this already dampened just due to the macro concerns. And we were like around 16. If I raise prices by 7%, right, automatically demand comes down by 5, and so we're at 15 million. And I'd argue there is the scenario of having tariffs stick, 15 million car sales and no recession is a very low probability.
So this then increases that chance. And I guess my other question is that demand that is deferred, or does it just go away? Does that person buy a used car, or do they just say, I'm going to wait another year or 2 year, run my car into the ground?
So we saw consumer behavior during COVID because people just kept their cars longer. That's going to happen. Cars are going to get older, and demand swaps onto used car markets. And that's why used car prices are elevated still and will probably rise in line with the new car market as well.
Dan, you were the perfect car guy to talk to today. Thank you so much for coming in. It was
Thanks so
excellent.
much.
Thank you.
My pleasure.